So the user-friendly budget is broken up into different sections, and you can see the name of each section by the sheet name. So Sheet UFB-1 is the property tax breakdown. If I scroll down, Sheet UFB2 is the anticipated revenues. Sheet UFB3 is the appropriations, otherwise known as expense summary. Sheet UFB4 is the structural budget imbalances. And then this is where we're going to pause and work for this coming week. Sheet UFB5, assessed property valuations. So this is going to be the tab that's going to tell us about the tax base in your town. And here's what I want you to do as part of this data exercise. So I'm going to bring my screen halfway across there, so I have a split screen. What I'm going to ask you to do is type in the data related to each of these headers from your version of the user-friendly budget. You can see that I've started it here by simply typing in 1 and vacant land for 1 and vacant land. And the idea here is that I'm going to kind of like input this data as I go through. And so you can see I just inputted all that. And then I want to do the same for the assessed value. Also, if your user-friendly budget allows for it, you can select the number over here, choose Command-C on the Mac or Control-C on a Windows or Chromebook, come back over here and do Command-V, and that'll just paste the number in. So you can do a quick copy-paste. So I now have the data from this left side of the tab populated over here, and what I want to do is return to this column C because I want to point something out about how this sheet is broken out. What this sheet does is it shows the taxable property on the left side of the sheet and then the tax exempt property on the right side of the sheet. And this kind of calls our attention to the fact that a community has a mixture of both taxable and tax exempt property. Now over here on the left, you'll see the names are sort of self-evident. Vacant land, residential housing, that's what residential is, commercial property, industrial apartments, and so on. These are taxable property classes. These are tax exempt property classes. And what we want to kind of be thinking big picture here is that some land and some buildings upon the land are sort of just obviously taxed. Like for instance, if you have a luxury rental building that is part of the tax base, it's going to incur property tax, and that's a taxable property, and it would show up on this side of the sheet. However, if you have a public school, that is a government building, same with a church or charity, cemetery, and so on, that's going to fall on this side of the sheet, and essentially these are types of structures and land uses that are not subject to property tax. So that's all that this is doing. The left side of the sheet is subject to property tax. The right side of the sheet is not subject to property tax. So bringing that idea of taxable versus tax exempt over here, what I want to do is I simply want to categorize all of these properties here as taxable. So a little bit of spreadsheet logic I'll just share. I can type the word taxable over and over again, or I could put my cursor in a cell that already has the word taxable, hover my mouse above this lower right blue circle, click down, and then drag down. And I'm going to drag it down to business personal property. So I can just drag that down. This is going to be exempt property, and I'll drag this down. And what I need you to do is then do the data entry for the tax exempt property. Now, an interesting thing as I look at this other exempt category, I do want to point something out here. This $9 billion of other exempt assessed value in Jersey City, that's where the pilots are, the abatements. Abatements fall into this category of 15F, other exempt. Okay, so I have my data inputted, and at this point, all I've really done is done some data entry into the spreadsheet. And now what I want to do is highlight this number here, the equalization ratio. This is the average ratio in percentage terms, and it's assessed to true value. So I have a few resources in our Blackboard folder that explain the equalization ratio. It's also called the average ratio or the director's ratio. And what this is telling me is that the assessed values in Jersey City are, on average, 82.9% of the market values. And we can see that because the $40 billion of assessed value of taxable real estate is 82.91% of the equalized or market valuation of the tax base, which is $49 billion. So I literally could do some numerator denominator math here, and if I do 40,889,213,020 divided by 49,317,588,976, I get 82.91%, and that's where the equalization ratio comes from. This is one of the most important numbers that can come out of our public data each year as it relates to tax fairness in the community. And I want to put 82.19%. Put a percentage in there. And I'm going to drag this value down and make it the same. Okay, so we're going to use this equalization ratio, and I want to just take you through some basic numerator-denominator math to explain the concept of what we're going to go through. Imagine that I have a property that has an assessed value of 8 and an equalization ratio of 80%. Now, what this is saying is that the $8 is 80% of the actual market value. Now I'm using $8 because I want to focus us on the math mechanics, not so much on the big numbers. So $8 is 80% of what number? And the answer is $10, right? $8 is 80% of $10. I think, once you kind of like get grounded in this numerator denominator math, it makes sense, right? $8 of $10 is 80%. What we want to do is I want you to basically be able to back into the $10 using the 8 and the 80%. And how do we do that? Well, 8 divided by 80%, and that gets us to 10, okay? So assessed value divided by equalization ratio gets us to market value. And again, this is simply numerator denominator math, and I would encourage you, if you need to, take a piece of paper where you might do $8 divided by $10, and you know that that's 80% of 100%. This is another way to think about the math that we're walking through here. So using this concept, we're going to back into market value for every single one of these property classes. I'm going to do it like this, equals 2.2 divided by the / 82.91%. And I'm then going to drag this down. And this is going to be the true market value of the property in your town. Okay? I'm going to get rid of this so that my spreadsheet is clean. Okay, so I have just backed into the market values of my taxable property, and I also have the market values of the tax-exempt property. So now let's look at how we can use this data. We want to ultimately be able to derive some insight and sort of unlock it from this sheet. So I want to run you through a couple of exercises. The first one being, let's create a small pivot table. And this is going to be a pivot table that we can put directly below the chart, or you can put it in a separate sheet. So I'm going to select all of this data, and I'm going to say Insert Pivot Table. And I'll put it below the sheet just for ease of illustration in this exercise. And then what I want to do is I want to break up my taxable versus exempt property. And I want to see what's the total value of both. And I should tie to this spreadsheet. I'm going to do equals, and I'll say assessed value. And you can see right there, I'm getting to the $40 billion here, and then the $17 billion over here, okay? Now let's say I want to add in my market value. I'm going to say equals market value, and it layers it right next to it. And look at that. Isn't that interesting? So I'm seeing here just some initial insights. The $40 billion is the assessed value, the $49 billion is the market value. And what's important here is that communities are supposed to be taxed according to their market value, meaning this $49 billion. The fact that Jersey City is still taxing its residents based on the $40 billion. So there's $9 billion of taxable property that is essentially market value that has grown disconnected from assessed value. And that $9 billion ultimately could be resulting in over or under taxation throughout the community. Now, in another exercise, I'm going to have you look at this on a specific homeowner basis. But the important thing with this exercise, so this is just one example of how we can derive value from a pivot table. Would also like you to create a couple of charts. So let's do this again. I'm going to do another pivot table. I'll put it in the same sheet, and I'm going to put it down here. Click OK. What I want to do is I want to visualize my tax base and how much assessed and market value is within each property class. So the way to do that is I'm going to choose the property class name. I'm then going to have a filter for taxable and tax exempt. And I'm going to choose only taxable, and that limits my property class names to only the taxable amounts. And I'll also choose assessed value, and I'll also choose market value. Okay. And because I'm a kind of a stickler for formatting, just for my own purposes, I'm going to make this left aligned. Okay, so now what I want to do is I'm going to highlight only my detail. I'm not going to include the total column, only my detail, and I'll say insert chart. And here what we start to get is a little bit of a visual on our tax base. And I'll put it right here next to the chart, and I'll remove this. I'll remove my pivot table right here. Okay, so we're getting a little bit of a visual. We can start to immediately see, okay, in Jersey City, most of the value is in the residential space, and then we also have a lot of value in the commercial. We also have apartments and then vacant land, and then we also have industrial. So pretty interesting. It'll be interesting to see the spread of the values in your towns and cities. So these are just two small data exercises that I would like for you to run through as it relates to your Sheet UFB 5. I will note, I will have another exercise for you related to the 82.91%, and I'll cover that in a separate video. Thank you.